Good afternoon, everybody. Welcome to the latest series session on Ask Anything with InCorp. Thank you for everyone who's joining us this afternoon. Today we'll talk about corporate income tax. Let me share my screen with everybody. Okay, hopefully everyone can see my screen right now. Before I start my presentation, just a couple of words on InCorp. InCorp is a one-stop solution, corporate service solution across Asia and the Middle East. We provide full corporate services ranging from market entry, incorporation, accounting, tax, HR, and payroll. My name is Jack Nguyen. I'm the CEO of InCorp in Vietnam. I have over 25 years of professional experience working in Canada, the United States, and Vietnam. Joining me today on the call is Mr. C. Pham. He is the head of corporate secretarial services and advisory. C has more than 15 years of professional experience and will be helping me answering questions during this webinar. All right, so let's begin. Today's series is on CIT, corporate income tax. There's been a lot of changes in corporate income tax in 2025, and that's the big reason why we are organizing this webinar to keep everybody up to date on the corporate income tax changes. The first change, a major change, is has to do with digital platform as the taxable presence. The United States government is now treating foreign digital platforms and online business as within CIT net. Okay, so for example, if an overseas app that may not have a presence in Vietnam, but is earning income from sales on their platform, will be deemed to have a taxable presence in Vietnam and therefore will need to pay corporate income tax for the Vietnam source income. Okay, so to be clear, this is the first time that Vietnam is taxing these foreign platforms. For example, if someone's selling on Facebook or TikTok shop to buyers in Vietnam and earning income from Vietnam, then those income will be taxed in Vietnam. Under Vietnam's new CIT law, foreign digital and e-commerce platform will be taxed on income in Vietnam, including permanent establishment rules. So this new rule closes loopholes and ensures overseas digital players pay like local businesses operating in Vietnam. Yeah, just give me a minute for me to adjust my screen so everyone can see. Yeah. Okay. Okay, hopefully the slides are bigger and everyone can see this. All right, on to the next slide. Another new change in the corporate income tax in Vietnam is the government introducing a tier corporate income tax rates, and this is applicable for small and medium enterprises. Okay, under the new law, micro enterprises those with less than 3 billion Vietnamese dong revenue will be applied 15% corporate income tax. Whereas small enterprises, those that have revenue between 3 billion and 50 billion Vietnam dong, will now be assessed 17% CIT. Okay. Whereas in the past, the normal corporate income tax rate was 20%. So now if you're a micro enterprise, you pay 15% corporate income tax. And if you're a small enterprise, you pay 17% income tax. Large companies above 50 billion VND is still required to pay 20% income tax. So with this tiered tax rates, it's a big relief for small and medium enterprise operating in Vietnam. And the one size fits all 20% tax rate is no longer applicable. On to the next slide. Capital gains. There was also change in the capital gain tax for foreign investors. So foreign investor who sell their equity of a company in Vietnam will now pay a corporate income tax on the gross sales price of the shares or capital, not just the net gain. Okay, so it's a corporate income tax rate on the gross sales price. And in practice, this is roughly 2% of the sale value of the tax as corporate income tax, replacing the old 20% applied on net profit. So now it's a tax on the gross sale price, not the net profit of the transaction. Okay, to be clear. And this gross base tax applies to indirect transfer as well, meaning offshore deals of Vietnamese assets. It ensures Vietnam captures tax from capital exits by foreign seller, making the tax system fairer and more comprehensive. Okay. CIT exemptions and incentives. Another new change in the corporate income tax is the new exemptions allow and then new incentives for invested enterprise in Vietnam. Under the new exempt income tax, profits from innovation or digital transformation projects now enjoy up to 3 years CIT free. Okay, so any profits from projects that are qualify as innovation or digital transformation can enjoy 3 years CIT free. Also, any research and development and innovation grants are non-taxable. So if the companies or projects receive R&D and innovation grants, then that's exempted from CIT. There's also new targeted tax incentives. Vietnam shifts tax incentives toward high-tech, digital, and green projects. For example, semiconductors, AI, artificial intelligence, and cybersecurity. Okay, whereas in the past, there was a blanket industrial zone breaks for tax incentive, but that's no longer the case. Tax incentive now is geared and focused for companies that are operating in high-tech, digital, and green projects, such as semiconductors, AI, and cybersecurity. There's also what's called SME conversion holiday. Micro and small firms that incorporate from household businesses get 2-year corporate income tax exemption. Okay, so this is acknowledgement for government that it's not easy for small household business to convert into a corporate. So they're giving a 2-year CIT exemption. And, as everyone know, over 80 to 90% of small business in Vietnam are household businesses. So this is a good, what I would call relief for small household business, that they get 2-year CIT exemption. So the exemption holiday is meant to give the SMEs to go formal, to become formal, giving startup a tax-free runway in the initial couple of years. All right, so another element of the new tax change is the expanded deductibility and loss um, offset rules. Uh, the government now allows for more deductions. So the rules expanded the deductions available. Business can now deduct R&D, tech development, green initiatives, emission reduction, and contributions to approved funds. Okay, so expenses related to these activities are now allowed for deduction for tax purposes. There's tighter expense documentation, stricter deduction rules. Proof of non-cash payment is now required for expenses over 5 million dong. So this is a much lower bar to require for proof of documentation for expenses, whereas in the past it was 20 million above. Now it's 5 million. So the government's encouraging more official bank transfer and e-payments for SMEs as proof of payment to be allowed deduction. And thirdly, flexibility loss offsetting. Loss offset rules are now relaxed starting in 2025. Companies can offset losses from one activity against profits in another. A flexibility that was not allowed before. For example, a loss in real estate can now be used to reduce taxable gains elsewhere, unless the profit comes from a tax incentivized activity. So if there were gains from other businesses, activities of the company, so loss from real estate can be used to offset against the other gains. So that's a great tax reform that the government has introduced, which will be a relief for companies who have losses and were not able to offset them in the past. So that concludes my initial slides that highlights the significant changes in the corporate income tax laws in Vietnam in 2025. I know maybe you may have questions. So InCorp tax services, tax compliance, tax advisory is a big part of our business, and we'd be happy to help answer or assist you with any tax issues or problems that you may have. And with that, I open the floor to Q&A. And for those who have any questions, we'd be happy to answer them for you. Thank you very much. Okay. Hi, C. I will start asking questions from the panel, and if you can help answer.
Yeah, sure, directly.
Okay, first question is, will corporate income tax, the new tax rate, apply for educational related services?
Yeah, to answer to this question, it depends. The first thing is that you have to identify whether the service you directly involved in the education activity in Vietnam. In that case, the corporate tax will be subject to from 10 to 15% based on in other words, otherwise in case your business.
Hi, everyone. I think C has technical problem. He'll be back get in a minute. Hi, C. Are you still there?
Yeah, sorry, I'm back. Internet
I see. Are
connection.
you there?
Yeah, I'm still there, but it's internet corrupted. Okay, back to the answers that in case your business activity is directed to the education activity, you can apply to your corporate tax will be subjected from 10 to 15%. Otherwise, or your business activity only relating to the supporting activity only, not directly the education activity, that you have to apply 20% on corporate tax common rate. And Jack have already mentioned regarding the starting from the 1st October this year, you can consider identify whether the total revenue of the receipt of the last year, whether the total revenue up to 3 billion, you can apply a tax rate of 15%. And in case your total revenue up to 50 billion VNG, you can apply 17% tax rate. Thank you.
Okay, thank you, C. Next question the audience has is, how often do the tax authorities conduct routine tax audits in Vietnam?
Yes, to answer this question is basically the tax authority internally, they have planned to conduct tax audit to the list of company in Vietnam. Basically, they also focus on the company which have the risk on identify the risk of tax, for example, so like that. For the company have not paid fully tax or late submission of tax return or something like that, the tax authority will plan and then we will visit those company on the for around after numbers of years, for example, after you officially incorporated in Vietnam. And basically, not in normal case, that tax authority will visit the company something like 4 or 5 years. We don't know because internally they have a plan to visit. And before they come, they will issue an official letter to inform the company and the day and the timeline they will visit the company and what they need the company to prepare for their visit. And this is mostly based on the internal decision.
Okay, thank you, C. Next question is relates to ultimate beneficiary owner. Is the reporting of UBO required in case a Vietnam company is 100% owned by a Singapore-based company? And when is this reporting effective? When is it required?
Yeah, basically the beneficial owner definition is the new definition based on the law of enterprise 2025. And this is mostly comply with the regulation on money laundering regulation in Vietnam. And basically the beneficial owner can be identified based on one of two conditions. The first condition is based on the ownership, the whole, for example, if the individual or at least 25% of the total capital or 25% or more of the total voting share of the enterprise. Indirect ownership can be understood that the holding just ownership through the other legal entity or agreement. The second condition is that the control is relating to the controlling right. When the individual have to be shall be deemed to have controlling right over an enterprise if they possess the authority to influence the decision on at least one of the foreign matter. The appointment, dismissal, or removal of the majority of the old members of the board of directors, the major chairman of the board of directors, etc. In that case, that if any individual have one of two conditions, is deemed as the beneficial owner of the Vietnam company. Then the key point is that when the company in Singapore to identify who is the beneficial owner of the Vietnam company, why the Singapore company is the owner of the Vietnam company. we have to identify the owner of the Singapore company, who is the owner of the owner company, and how is percentage owned by that individual, or those individual, how many percent of ownership of those in the Singapore company. And Vietnam authority also provide the regulation on how to identify the beneficial owner of the Vietnam company by multiplying the ownership between the ownership of the Singapore company and the ownership of the Singapore company in the Vietnam company, to identify whether he or her they have ownership of 25% of the charter capital, or have controlling right in the Vietnam company or not.
Okay, thank you, C. Next question is, as an SME manufacturing electronics in industrial zone, what does the removal of blanket incentives for industrial zone mean for us? Will we need to relocate to a high-tech zone or a special difficult region to qualify for the corporate income tax break? And what are the thresholds or conditions? So because of the new change, there's no more blanket tax break industrial zone. So the question is, what can this company do?
Okay. To answer this question, firstly, we would recommend you to review all what incentive the company in Vietnam is subject to. For example, any tax incentive or tax holiday that the Vietnam company is subject to. Um, uh, uh, for example, you already know in the law of corporate tax in 2025 that the industrial zone or industrial park in Vietnam will not be subject to tax incentive anymore. But there's a transition transition provision of the corporate tax law in Vietnam, applying from the 1st October to 2025. In case that the Vietnam company currently subject to tax incentive, and into the new law that you can continue apply this tax incentive for the entire period. Otherwise, if the Vietnam company have not in subject to tax incentive in the past, but from the 1st of October 2025, the company have to subject to any tax incentive condition based on the corporate tax in 2025, the company in Vietnam can apply from the 1st October 2025 onward. Therefore, you can, the first thing you need to do is to look back all the condition of Vietnam company, whether the Vietnam company is subject to any tax incentive or not. You don't need to immediately locate the company to the incentive location. But actually, if the Vietnam company does not have any tax incentive in the old and the new law, you can, another option is to establish another investment project in the high-tech zone, difficult or social economic area that to be subject to tax incentive.
Okay, thank you, C. Next question is, we are a small retailer with annual revenue around 4 to 5 billion dong. The new CIT law mentioned lower rate bands, for example, 15% or 17% for a certain revenue threshold. What do we need to do to qualify? And are there any activities or revenues excluded from these lower rates?
Yeah, the new laws in corporate tax introduce the professional tax rate for small enterprise subject is 15% and 17% based on the revenue of the preceding year, and to qualify for applying for the new tax law, the new tax rate, that the business must meet the revenue they hold and not engage in the new laws on corporate tax also mentioned that the new tax rate will not apply to the company which have the business activity of capital transfer, real estate transfer, or investment project transfer and the revenue from activity outside Vietnam. Additional point is that for the company with in the related party and the interrelated party, one of the company and not subject to taxes, the tax incentive will not be subject to the new tax rate also. Condition to apply new tax rate, of course, that the Vietnam company must comply with the accounting methods that of Vietnam accounting standard. The revenue is properly measured and the excluding income separately with all the activity. And the benefits from the lower CAT rates will improve your tax after tax profit margin.
Okay, great. Thank you, C. Okay, C, can you clarify a bit more on the new CIT for platform? Let me go to that slide. I think one of the question is, can you elaborate more on the taxable presence in Vietnam for e-commerce platform that sells in Vietnam?
Yeah, for the PE, it means the permanent establishment. It means that the definition regulated on the regulation on the foreign contractor withholding tax in Vietnam. And to identify whether the foreign entity have something the PE in Vietnam or not, something like the PE means that when the foreign employee is deemed to have a PE in Vietnam, when it has it's conduct business in Vietnam through one of the foreign firm, like a branch or the representative office or the visited location or something like that. And in that case, that when the foreign company is deemed to have a PE in Vietnam, that the foreign company will be subject to tax, foreign contractor withholding tax, based on the there's for the corporate foreign contractor withholding tax. There are three methods of it for the foreign company to apply in Vietnam. Deduction methods, hybrid methods, and deem methods. That is mostly. And for the deduction methods, that's mostly applied to the company with fully comply with the accounting standard in Vietnam and maintain fully with, for example, accounting record, documents, everything. They look like the same with the Vietnam company. For hybrid methods or for the deem methods, they is applying to certain cases whether the foreign company does not fully comply with the accounting Vietnam accounting standard and can apply other two methods.
Okay, great. And with that answer, we have no more questions from our participants for this afternoon series. So with that, I want to close out this series. If anybody have any more additional questions after this, please kindly contact InCorp, and one of our experts will be happy to answer any questions you may have. Again, tax compliance and tax service is a big part of our business, and we'd be happy to assist individuals or businesses that may have any tax questions, issues. Thank you very much, and we'll see you again at the next Ask Any series. Thank you.